ETFs, short for exchange traded funds, have been growing at an incredible rate over the past few years, where you may have seen other videos of ours on ETFs like VOO, BTI, or QQQ that are all among the most popular ETFs ranked number 1, 4, and 5th in the world based on their total assets under management. But as you scroll along this page to view the top 100 largest ETFs, you'll notice that the ETF SPMO is actually not in this list, which is why we believe that it is one of, if not the most underrated ETF currently available in the market. Now, if you don't know what ETFs are, they're pretty much a simple way for you to invest into hundreds to thousands of different investments that track a particular market segment, all within one purchase. And so in this video, I'm going to cover what SPMO is, compare it to other top growth ETFs in the market, and why you may really want to consider adding SPMO as part of your investment portfolio. But before we get started, my name is Danny Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, let's first go over what is SPMO. Now, SPMO is referred to as the Invesco S&P 500 Momentum ETF, and if we look at the fund's prospectus, you can see that it seeks to track the investment results before fees and expenses of the S&P 500 Momentum Index. And how this exactly works is that this fund is designed to measure the performance of approximately 100 stocks in the S&P 500 Index that have the highest momentum score. Now, if you don't know what the S&P 500 is, it's pretty much a way to buy 500 of the largest US publicly traded companies, and it's often referred to as the US stock market benchmark. But as far as the momentum style from SPMO, understand that in general, momentum is the tendency of an investment to exhibit persistence in its relative performance. A momentum style of investing emphasizes investing in securities that have had better recent performance compared to other securities. All in all, SPMO first calculates the momentum score of each stock in the S&P 500 and then evaluates the percentage change in the stock's price over the past 12 months, excluding the most recent month, and it applies an adjustment based on the security's volatility over that period. Now, there's much more you could read about with this index if you want to understand every detail, so if you're curious, I'll have a direct link in the description below if you want to check that out. The first data point to mention here is that the fund currently contains 100 stocks, where you can see the top 10 holdings include companies like Broadcom, Nvidia, Meta, JP Morgan, and Palantir that each have about 5% or more of weight toward the performance of the fund. And the nice part about this is that if we compare it to the traditional S&P 500 index fund, the holdings are going to vary slightly, and is why there is a 30% overlap by weight between SPMO and the popular S&P 500 ETF VOO. Now, aside from that, also know that SPMO currently has an expense ratio of 0.13%, which is the annual cost it takes to own the fund per year, and all that means is that for every $10,000 that you invest, it would cost you $13 per year in fees, and do know that that cost is automatically taken out of your investment over time. It's not something that you have to pay separately. On top of that, also know that SPMO over the past year has paid out a low dividend yield of 0.73%, and as of December 31st of 2025, the fund is made up of 34% technology, then 21% financials, and then 14% in communication services. Now, this fund has just recently hit its 10-year mark, but before I discuss historical performance and why to consider SPMO, let's compare SPMO to other popular growth ETFs. So the first ETF to compare SPMO to here is an official S&P 500 ETF like VOO, IVV, SPY, or the alternative SPYM. For this case, I'll use Vanguard's S&P 500 ETF, that is VOO, and do know that the biggest differences to know about here is that VOO currently has 505 stocks in the fund. Its top companies are based on the largest ones currently in the market that are Nvidia, Apple, and Microsoft, where the largest sector exposure is also technology at close to 35% of the entire fund. And do know that this fund launched in 2010, it is cheaper at a 0.03% of an annual expense, and its dividend yield over the past 12 months was 1.11%. Now, I'll show you in a minute an entire comparison of historical data between these top funds and SPMO, but the next one I want to cover is a large cap growth fund where you may be in the consideration between SCHG, VUG, QQQ, or QQQM for those solely looking to buy and hold long term. And so because QQQ is the largest of those options, where it is currently the 5th largest ETF in the world with roughly $410 billion in assets under its management, understand that QQQ seeks to track the NASDAQ 100, where it has beaten the S&P 500 7 out of the last 10 years. And so the key things to know about QQQ is that the fund gives you access to the performance of the 100 largest non-financial companies listed on the NASDAQ, where the fund launched in 1999, currently has 102 holdings, a total expense ratio of 0.18%, where the top 10 holdings that make up this fund include Nvidia, Apple, and Microsoft, where each have between 7 to 9% of the weight toward the fund, where technology is by far the largest sector in the fund by having roughly 64% of the weight, with consumer discretionary thereafter. And so largely because of that exposure, QQQ currently has a 52% overlap by weight with the S&P 500. And like I said, I'll show a comparison of the historical performance for each ETF in a second. But the last ETF that I want to mention here is another popular growth ETF many also love. That is the Vanguard Information Technology ETF with the ticker of VGT. Now, VGT is a sector ETF where you can see it measures the investment return of stocks in the information technology sector, has a 0.09% expense ratio, a super low dividend yield at 0.4%, and VGT is ranked as one of the largest ETFs in the market, where you can see the fund currently has about $115 billion in assets under its management. And so looking at the portfolio composition, you can see that VGT currently has 322 stocks, where the top 10 holdings in the fund are again companies like Nvidia, Apple, Microsoft, and Broadcom. But notice the top 3 in this fund each make up double-digit weight, making up over 40% of the entire fund among these 3 alone. Which, if we look at these specific sectors inside of this tech sector ETF, you can see semiconductors at the top, then system software, technology hardware, and then applications software. And do know that with this heavy tech exposure, VGT currently computes to have a 34% overlap by weight with VOO. So to keep things simple, I'm going to compare VOO, QQQ, and VGT to SPMO. And if you're curious, the software I'm using for this is called Portfolio Visualizer. It's completely free, and I'll have a link below to some of the top investing tools and resources that we recommend in the description below. But the main things to be aware of here is that this study is coming from 10 years of data that is from the start of 2016 to the end of 2025, where you can first see that from the start to end balance of a $10,000 investment from 10 years ago to today, VGT, the Vanguard Information Technology Sector ETF, would have grown the most. But the key things I want to point out here is that the S&P 500 ETF VOO would have averaged 14.79% of an annual return per year, QQQ would have been 19.45%, VGT would have been 22.5% being the highest, and then SPMO would have returned about 18% per year over the past 10 years, which is more than 3% higher than the S&P 500. But this is where things really stand out to me, because with SPMO, if we look at the best and worst year performance over the past 10 years, for VOO, the S&P 500, the best year was up 31%, where the worst year was down 18%, and then QQQ's best was up 55%, with the worst being down 32%, and VGT is very similar, with the best year being up 52% and the worst year being down 30%. But notice that over the past 10 years, if we compare that to SPMO, the best year that SPMO had was up about 46%, but the worst year was only down 10%. That makes me feel that even though the standard deviation is in the middle of the metrics between these ETFs, that SPMO can potentially reduce downside risk, especially when compared to sector ETFs. Which, not to mention, but the Sharpe ratio, which shows how much return the fund generates per unit of risk, SPMO is almost the highest of all the options, easily outperforming the S&P 500. Now, if you want to create your own portfolio and analyze different scenarios, companies like Seeking Alpha, Morningstar, and Stockrover are some of the top ones in the market that can help you out with that. And like I said, we'll have our top tools and resources page linked in the description below for you. But now that you have a better understanding of SPMO and other top growth ETFs, let's now finish this off with a quick summary on why to consider SPMO. Now, at InvestLane, we believe that the S&P 500 is among the best overall investment that nearly anyone can make to build the foundation for a long-term investment portfolio. But due to SPMO's structure and historical performance, the fund seems to be a great addition to a portfolio if you are one looking to gain even more potential for higher returns over time without adding significant risk like sector ETFs or individual stocks. And while the expense ratio is slightly higher at 0.13% per year, if you could average 3% more growth every year for 10 years due to the momentum structure of SPMO, that would by far outweigh the cost. For example, if we plug in a simple portfolio into StockRover that contains 80% VOO and 20% SPMO, if we look at the difference in growth over time, that would have led to a total of 342% in total returns. When compared to the S&P 500, that would have been 322% over the past 10 years. And just for fun, if we instead test out a different portfolio with the growth ETFs I mentioned, if we do 40% VOO, 20% QQQ, 20% VGT, and then 20% SPMO, that's very aggressive, you can see that this portfolio over the past 10 years would have grown 431% in total returns when compared to the S&P 500 that was 322%, or the Dow Jones Industrial Average that was 199%, or gold that was 307%. This 4 ETF portfolio would have outperformed the market. And if we look at this simple portfolio even further, the combined sector exposure would be 52% towards technology, then 10% communication services, and 9% financial services, where a Monte Carlo simulation of 1,000 different samples to project a potential future outcome with this portfolio, it computed that this portfolio from the mean of all 1,000 samples could potentially average 11.4% per year over the next 10 years, which outbeats the S&P 500 projection of 6.7%. Now, please realize that no one knows what the future holds, and the past does not guarantee anything in the future, and in the end, you have to do your own research and make your own financial decisions. Now, I will say, because you've stayed this long into the video, that we've created an entire free index fund cheat sheet that shows a quick breakdown on some of our favorite index funds, which I'll have that linked in the description below for you. And don't forget, if you want to start investing on a new platform, check out other free content, or even some of our top investing tools and resources, we'll have direct links in the description below for you. At the end of the day, our mission at InvestLane is to help you save and invest wisely to build lasting wealth. So please do whatever you believe is best for your situation. This is not financial advice, and you must do your own research. Which, if you found value in this video, don't forget to hit the like, subscribe, and notifications button for future content like this.